welcome to another video from Creativo Solutions. You're currently watching the Accounting for Non-Accountants video series. I hope you've enjoying the actual content, and please post comments and questions below. Tell me which videos you like and which videos you would like me to make to help you with your accounting. Please subscribe to the channel and visit the website for more content and resources to help you. Today we're going to be expanding on the accounting cycle. We've discussed it briefly in the past where we've looked at the process. So when looking at the accounting cycle, there's a very specific process that needs to go through in terms of reaching the ultimate goal, which is a set of financial statements. The first is obviously the transaction. The second is the source document that we'll have as part of the actual proof that a transaction has arose. And then we'll have journals and ledger, which is looking at the recording. Then we're going to be checking by using a trial balance, and then ultimately drawing up a set of financial statements. So this is what we're going to be discussing in more detail in this particular video. Step number one, the transaction. We know accounting is a language for communicating information. So when looking at the actual communication of financial information, we need the data, and the data comes from the actual transaction. So before we have any sort of financial record, there needs to be a transaction between a buyer and a seller. We're looking at the Bookshop here, which is the example we've been following in this particular video series. We know the Bookshop is going to be selling goods to the customer. So if books are sold to the customer is then going to pay for those books by using cash. Has there been a transaction here? Yes, there has. There's been an exchange of goods and services for cash. So when looking at a transaction, we know there are going to be two parties involved. Remember, two parties are involved because you have a transaction which involves a business and someone external, in this case, the customer. So remember the double entry rule. The debit and the credit. We know that every transaction must have two sides, and that's why, because the transaction will always have two separate perspectives, either from the business's point of view in terms of the bookshop, or either from the consumer's point of view. Remember, they'll view the transaction very differently. So if we just discuss some of the important terms, if the bookshop is selling to the customer, that's viewed as something positive. So we could view that as being income, okay, that the business is receiving. And if we take things from the customer's point of view, they're paying the business. So from the customer's point of view, that'll be viewed as an expense. So again, accounting is very specific to the business because the accounting records are going to be provided for in the actual business. So the business is always the focus. Whenever we're focusing on transactions, we're always looking at things from the business's point of view. So in this case, the bookshop will be recognizing a sale because the bookshop has sold goods to the customer. Step two looks at the source document. What is a source document? Well, it's evidence or it's proof that a transaction has arose. We need some sort of till-slip invoice or receipt here in this particular example because the bookshop needs to recognize the sale. So yes, the books are being exchanged for cash, but there needs to be proof that that has indeed occurred. And the way we do that is by completing a source document. So the bookshop will fill in a till-slip or an invoice or a receipt, and it's normally generated on a computer system, and that particular receipt is then issued to the customer as proof that a transaction has occurred. If you're giving the customer the actual original source document, the business is going to want to keep a copy so that both parties have record that that transaction has arose. Step 3 and 4, we're looking at journals and ledgers. So now the business has been operating, and obviously the longer the business has been operating for, the more source documents they'll have. So now what must we do as the accounting department in the actual entity? Well, we'll have to record and keep track of all those transactions. And if that bookshop is very, very successful, we're going to have many transactions. They'll probably be selling hundreds or thousands of different books. So if that's the case, there's going to be a journal and there's going to be a ledger. If I focus on the journal, what are we trying to do with those transactions? Well, let's think about it. If you're going to be selling not only to one customer, but to 100 different customers, there's going to be 100 different sales transactions. So a journal is a way to classify different transactions. It's almost like grouping those transactions that are similar in terms of their type in a specific journal, a place where I can view all the transactions that are very similar in the actual nature in terms of what actually occurred. So when looking at a journal, you could have something like a cash receipts journal. So if I'm focusing on that, what transaction am I trying to identify? Well, receipts. So any receipt that would arise in the business will be recorded in the cash receipts journal, so long as I'm receiving cash, because it's specific to a cash receipt. The next bit is looking at a ledger. A ledger would be a detailed snapshot of a specific account. So if I'm looking at transactions, for example, selling books, I could have an inventory account which would manage the book sales in terms of the products that I'm actually selling. Okay, so to keep track of how many books I've sold, I'm going to need a cost of sales, or I'm going to need an inventory account in order to provide for all of that stock which is being sold to outside people. So a ledger is a way to keep track of a specific account. The most common account that you'll probably see in all types of businesses, because businesses are going to have a bank account. They're obviously dealing with cash, there'll be receipts, and there'll be payments. So when looking at the bank account, that would be one specific account that will be part of a ledger. Okay, and the ledger accounts are normally referred to as T accounts because we'll have a debit side and we'll have a credit side. And now we've got the last two steps, being the trial balance, which is step number 5. What happens with those journals and ledgers? Well, remember, that would be part of the bookkeeping process. So we're capturing the information. Once we've captured the information, there needs to be some sort of check or confirmation. So the trial balance is going to allow us to create a list of debits and credits. If we have a list of debits and credits, we can confirm if the rule has been followed correctly before generating a set of financial statements. And that's the ultimate goal in terms of the accounting cycle, or the process that we need to go through. The final step is to generate the statements. Can we disclose the information correctly to our users so they can then ultimately make a decision? And this takes us to the end of this video. Thank you very much for watching. Please subscribe to the channel and post your comments below. Tell me about which part of the accounting cycle you're most comfortable with, or are there parts of the accounting cycle that you would like me to expand on? Please let me know and I'll make the video to help you.